I'm going to follow in Brian's footsteps and sit down with the rest of the panel. So I'm Nick Katsanos. I'm a partner at the law firm of Seward and Kissel, where I focus on M&A, and that is the topic of this panel. And the three participants here really need no introduction, and I think bring very different perspectives to the topic. To my left, Mark Friedman, Senior Managing Director at Evercore, James Doyle, Head of Corporate Development at Scorpio Tankers, and Mark Filanowski, CEO of Pangea Logistics Solutions. So I'll just jump into it. So gentlemen, there's been a lot of drivers for M&A in this industry over the last, 5, 6, 7 years. And, at one point it was, private equity and large private equity shareholders looking to exit. And then it became more of, companies looking to get larger in order to be able to attract capital. There's been, looking to renew or get younger fleets. What are going into 2025, what do you see as the drivers, if any, for M&A? Mark, I don't know if you want to take that first.
Sure. Happy to.
Which Mark? Mark? Go ahead, Mark.
All right. Mark Friedman.
Thanks, Nick, and good to see everybody today. Well, as I sort of think about 25, let's maybe quickly review 2024, which was, among the most active years in M&A. And if you look at some of the deals that got done, the sale of OSG, the sale of Navigate, BlackRock selling its stake in GasLog, BW and Avance doing a large deal, Graham Carriers selling to MSC, Starbulk Eagle. What's the point of commonality? I'd say in general, higher share prices, higher asset values, higher prices typically bring out sellers. No surprise there. Now you need a buyer who will have a reasonable amount of conviction to pay a high price. But in 2024, there was a fair amount of optimism. Freight rates were high, and it led to a pretty liquid market. I think 2025 is a little bit more interesting because we've seen now freight rates crack in most of the markets. And so, will we see the same sustained level of activity? My instinct probably says no. Interesting, when you listen to the last panel, the one thing that is clear to support the M&A market is an incredibly ample amount of financing. And company balance sheets are super strong. So we have that as momentum, as well as look for the right set of assets. Many of the public companies, at least, are sitting there with fleets that are aging. Many haven't participated in new build orders. And overall, modern assets are pretty scarce. So there's a lot of incentives there. So we'll see.
James and Mark, you want to add anything to that? Or?
Sure. I think maybe some negative stimuli in the market that's going to drive M&A transactions. We all, in the dry bulk side anyway, all felt a year ago that we're setting ourselves up for a pretty big supply bonanza here. That the new building order book is diminished, and supply is going to be restricted, and isn't it going to be a great market? Well, it hasn't turned out that way. That the new building order book has filled up quite a bit. There's a lot of ships going to be ordered. The market's been good enough. There hasn't been a lot of scrapping. That was touched on in the last panel. And I think a lot of owners are going to become a little disillusioned and try to maybe exit this segment. On the other hand, I think there'll be a lot of buyers out there looking for well-priced assets when asset values do drop some for modern ships. People are out like we are, trying to keep a modern fleet afloat, It's more efficient, it's more profitable. At the end of the day, we are believers in the market. It's going to come back.
Yeah, and from the tanker perspective, I would add, we've taken a different approach in this strong market. So, we recognize that these markets often come on with black swan events, and as Robert highlights, we're not very good at predicting those. We didn't predict, 9/11, the Asian currency crisis, COVID, global financial crisis. So we have to take a counter-cyclical investment approach. And so what we've done first in this strong rate environment is pay off a lot of debt, significantly reduce our leverage. And actually, we've been, over the last 2 years, selling assets. So we've been selling our assets at what we believe to be attractive prices. In some case, selling assets that are 10 years old for more than we paid for them new. And we think that's going to position us really well. And then the second thing we've done is really lower our break-evens. And then looked at shareholder returns opportunistically, mainly through buybacks. So we and many of the other public tanker companies haven't really gone out and ordered new ships, as Mark highlighted, maybe a few here and a few there, but not that, large new building order program. And others have ordered, so it'll be interesting to see how that unfolds. But the public companies themselves, and in dry bulk as well, have remained disciplined.
In terms of share buybacks, James, do you think that we're going to see more of that in this environment?
I think we've seen a lot to start. We've been a big purchaser of our own shares, but you saw, Hafnia, Golden Ocean, a lot of other, INSW, maybe Dorian as well, a lot of other public companies go out there and look at, where their share price is and where their intrinsic value is. And buybacks can be accretive. So depending on the price that you repurchase at, specifically for us, we were able to crystallize our NAV in the sense that we were selling assets, right? Mm-hmm. Well above where the share price was trading and then going out and repurchasing that stock. So kind of crystallizing it because your NAV is always moving. But yeah, I think share purchases, make sense. One of the things we didn't do was say we're going to commit to a full payout model because historically, if you pay out all your cash and then you go out and order new ships and you don't delever enough, the market eventually turns out of your favor and you're in a difficult position. Right. So how can we position ourselves for if that situation happens? How are we going to be well positioned? And that's the route we took.
Okay. I think one of the things that's been mentioned is that, right now we've got a combination of relatively high asset values and relatively low share prices and valuation. And how does that sort of play into the M&A market? And maybe
Sure.
Mark Friedman, you want to
Sure.
start on?
Well, I think, as I think about it, and it probably as James and others think about it on the company side, these are key capital allocation questions, right? So, particularly on the tanker side, rates are down, but there's still pretty strong free cash flow. So James and Robert, I'm sure, think every day about how to allocate that cash flow. And in the context of asset values that I think maybe conventional wisdom now is that, they'll crack a bit. So maybe you'll hold off on buying assets and devoting money to capital expenditures. So in that context, Scorpio and many others have actually been, more active on share repurchase. That said, most companies take sort of a portfolio approach to, how they have to buy their fleets. You don't want to have sort of a situation where the fleet is getting really old and it's sort of cliffing. So, trying to be sort of disciplined too about, buying assets is important. In the M&A context, it is a challenging set of facts because, if your currency doesn't have the requisite value, are you going to go out and, pay top dollar for assets? Probably not. There's still the possibility of doing stock for stock deals where in that context, it's really about relative value. And obviously, I'm sure, Mark, you can talk about it. You guys did what was really hard. You found a seller of assets that was taking your currency effectively at NAV, which is really hard to do, and congratulations on that. But that's a tough set of
Yeah,
circumstances.
thank you, thank you. It was a special transaction we did. We have it's a small public company. It's a tough world out there. We've got to show we want to grow. We want to get the stock price up. Maybe we could do a buyback, but we want to save our capital for growth. We did find a way to use the stock this time to buy 15 ships on block from a private owner who took our stock back at relative NAV. So it turned out to be a great transaction for us, a great way for us to utilize capital markets in a way we never have been able to do it.
You need a really long-term oriented seller to do that. And congratulations on that.
Thank you.
I guess, Mark, just to add to that, I mean, given the valuation gap, do you find that in the past you've tried to use M&A as a way to try to address that? And I don't know if you've got any examples you want to
Well, when we tell our board that we think our stock is worth an NAV of X, but is trading at X minus, 40%, it's tough to do anything, really. We've got limited capitalization to go out and buy the stock back at what we think is a cheap price, and we don't want to sell it at the cheap price either. So it is very difficult. We've talked to different people about it before, but they wanted something more in return, a control position or something like that we weren't willing to do because the premium just wasn't enough. So this transaction was special. It was, as Mark said, some long-term, very experienced people in the shipping business, knew what they're getting into, and great supporters of the company.
So one of the things that I've heard in terms of the valuation gap, and it's more like whispers or comments, you hear from public companies sometimes is, we've tried everything and we still have this valuation gap. Is it really worth it to be a public company? Should we take it private? And I hear it, I've heard it a few times, and I think, all right, is this person venting or are they serious? And I don't know if any of you have any thoughts on whether you think that's realistic, that we're going to see more of those, or whether it's just,
Sorry, James, you should jump in. I don't want to take too much mic time, but look, we've seen a lot of it. I mean, we at Evercore actually worked on 6 privatizations. So it's not just people belly aching about it, but there's actually been a lot of follow through on it. And, where we saw it in particular was on the marine MLP side, which, look, Wall Street loves to overcapitalize any trend. We're really good at that. If a deal works, we'll do 2, and if it works well, we'll do 3, 4, 5, 6. And so, on the marine MLP side, we ended up with a lot of companies, some of which, the business model worked, for some it didn't. Ultimately, the MLPs did fall out of favor as a category. And so that led to some real inefficiencies there, real illiquidity in the share prices. And so many of the marine MLPs have now privatized. And it's not just the MLPs, but, we've obviously seen really great companies like GasLog privatize as well. So is the public markets still, a place where companies want to be? For some, sure. It's still great access to capital, but it requires you to be pretty picky, right, about when you're going to access that market. And, there's a certain, element of spending a lot of time cultivating a market that isn't showing a lot of love.
Yeah, I agree. We've definitely seen it, but it depends on the sector as well. So where you've seen a lot of the public scope private is long-term contracts, right? And that's much easier to take private than a spot-oriented tanker company.
Yeah.
But what I think is relevant is the fact that, investors over the last 3-4 years have actually made good returns in shipping, which hadn't really happened for a decade. Whether it was the containers or dry bulk, now tankers, investors, I use our own stock as an example, could have bought Sting for $10, $11 and ended up going up to 80.
Yeah.
And that hadn't happened in a long time. And then what those public companies, for the most part, did was really fix that balance sheet, as I kind of highlighted. We paid off $2.2 billion of debt. If you look at publicly listed shipping companies, they paid off over $600 billion of debt in the last 2 years. So they have been responsible. But I think what we are talking about too is just a broader market situation where if you look at the U.S. equity flows, at least 50% are now passive, right? And we're small. We're small in the grand scheme of things. Even larger oil companies face, what are very cheap valuations, right? And so you've seen a lot of them kind of lead buybacks as ways to close valuation gaps. So it's not just shipping. I think what you've probably seen is with these larger market flows going to these larger companies, NVIDIA, the Mag 7, you fall further away. And energy as well has just become a much lower percent of their overall S&P. And we are, in this weird kind of energy shipping transportation spot. So it's not just us, but it is something that, a lot of smaller companies are facing.
Yeah, we always blamed it on size, but if you look at our size, which is, $350 million market cap today or so, you look at Starbuck, they're $2.5 billion or something like that, and they still trade at the same discount to NAV. So I'm not sure if it's size. James, you mentioned segment. I'm not sure if it's segment either that addresses this value gap. I think it's maybe the cycle. People are in this business for the excitement. They're in it for the cycle. They want the C story to say they went from 10 to 80. And once it gets to 80, things start to drop back down because the cycle tends to be over. I think that's really where we are, where it's a very cyclical business. We've got to realize we're in it that way.
Right. I mean, one thing that may be impacting the valuations is just, an expectation that we'll see asset values fall. So, sometimes investors are actually out in front of where, appraisal firms are or, the S&P market. So if that happens to be the case, then we'll see. Then the NAVs may not be as discounted as we think right now.
But also, we would have to add that there's been a lot of news, politically related events that will, whether it happens or not happen, reduce the number of investors that want to say, hey, I want to look at this space right now. Because the amount of time it takes to do all that research and figure out these what ifs is a lot. And there's a lot of great companies out there you can invest in across the space.
Mm-hmm. Just on that point, the geopolitical stuff, obviously tariffs and trade tensions and all of that, does that play into any decision in terms to go forward with an M&A deal or not? Do you think it has a chilling effect, or is it more like people see it as an opportunity?
I mean, in general, when you're doing M&A trade, you want to have conviction and confidence. Mm-hmm. The future is always uncertain, but, to the degree that you have outsized volatility or expectations of volatility, that could dent some of the M&A activity or enthusiasm.
Yeah. So that plays into maybe what you were saying earlier, Mark, about how it may not be as busy as last year, perhaps. Well, I guess we'll see.
Yeah.
So just because I see the clock ticking, I want to get into the weeds a little bit here. James, maybe you could tell us a little bit about what makes a successful deal and maybe some examples of deals that you've worked on that were successful and why that was the case.
Sure, I'll start, and Mark probably has some to add.
Yeah.
So if you think about Scorpio tankers, fleet growth from 2012 to 2016 was a large new building order program. Mm-hmm. But the future fleet growth in most of the modern fleet is an acquisition from Navigate of 27 ships in 2017 and 19 ships from Trafigura in 2019, which we used our shares as predominantly as payment. And that really benefited the company for a few reasons. First, it increased our scale, specifically in the Navigate transaction on the LR2s. It also made the fleet younger. Both of those fleets had an average age of less than a year. And then when it came to Trafigura, it made us the largest scrubber-fitted operator, ahead of owner of IMO 2020. So those did several very attractive things for us. And we also did this, most importantly, at what we believe to be cyclical low prices. You know, we have to do our best to buy at the bottom. And that's why now, as we've seen asset values come up, and you've heard other panels talk about where the order book and the pricing is, you know, that's why we've sold some assets, specifically our oldest ones. But those things really, the right rationale, and then obviously you need investment support, but to have the time to go and be able to execute that. And then the hard part is hoping that market turns, right, which is actually the hardest part.
I think James hit it in terms of, you know, usually in shipping, it's not like this unbelievable industrial logic of putting assets together. Though, you know, occasionally, look, the LR2s were a great fit, so
Right.
I don't want to diminish it. But, you know, this is an industry about timing your entry and timing your exit. And usually, you know, sometimes the best deal is the one you don't do. And, you know, a number of times, you know, companies felt their back up against the wall and had to do a deal. You know, I think one of the reasons why I think the sale of OSG got a lot of good press was, you know, the company had the cycle was tough. And, you know, there was times where, you know, there was pressures to sell the company at much lower levels. And, you know, thankfully, they were able to refinance and buy time. And with shipping, anytime you have, the key value of an option is time, right? And so, the same can be said of how you sort of time the sale of the company. So, you know, you want to have a good capital structure so that you can sort of control your destiny on, you know, when you come to market.
Yeah, my first real transaction, the shipping business, was back in 1989. I think, Bob, you were involved in that one. I remember we took a company private, and the former chief executive officer got an interview, and somebody said, well, how did you make so much money, Mr. Chief Executive Officer? And he said, well, in this business, you got to buy low and sell high. And I said to myself, that's the stupidest thing I ever heard of. But the guy went to Harvard, so he must be smart. And today, that's exactly what we're all saying. Yeah. Pick your entry into the market. That's the one thing you can't manage after you take the transaction. After you close the transaction, you can't change your entry price. All the other stuff you can work around.
I guess, Mark, just to follow up on that, so you just completed a transaction, and you've seen a number of deals over the years in this industry. What would you tell someone who hasn't been involved in an M&A deal, you know, what to kind of be concerned about or be thinking about, red flags, things of that nature, when they pursue a deal?
Well, I guess if you buy the asset at the right price, you've got to then start filling in around it, and it's people more than steel that make a company. You've got to operate the ships. You've got to operate them safely. You've got to deal with customers. You've got to do all those things every day that every business has to do. It's not just about the selling and or the buying and selling at the right point. In between, there's a business that has to be run that needs to be done with the right partners and the right people. And if you get on the wrong side of that, it's a difficult sled.
James, do you have anything to add to that, or?
I would agree. We had another transaction where Anetti, wind turbine installation vessel company, merged with Cattler, and which the Cattler management was still running the business today, but that made a lot of sense. The two companies themselves were quite small, low market cap, limited trading liquidity, tough valuation, and also competing against each other for various contracts. But the synergies to combine those companies, because it's a small fleet of, you know, the whole market is maybe 20 or 30 ships, and this would have put, 10 high-spec vessels together, made a ton of sense. And we had a lot of respect for the management, the operations behind Cattler, as well as the experience we had with CJAX. And those two merging together turned out to be quite successful, and shareholders have done really well as a result of that. So that, to what Mark highlights, is really important, and turned out to be a successful transaction.
Kind of a little astray from what we've just been talking about. I kind of skipped over it earlier. One thing that I mean, we've seen it now and then in terms of like hostile bids in the market. I haven't really seen a lot of activist type situations. Given given where we are currently, do we think that we may see more of that in the near term?
I mean, we have seen, typically the shipping industry does not have traditional activists.
Right.
We have seen, George Economou effectively try to fill that role with respect to a number of companies.
That's right.
Right, so we've seen that. Typically, too, you don't see many hostile offers in the shipping business. Typically, stock-for-stock deals are really challenging to get done in a hostile way because you have a big fight over relative value. What could be different here? Balance sheets are really strong. We talked already about banks really wanting to lend more. And so if we have a sustained period of, low valuations and companies having the ability to do, cash deals, then at least there's a possibility of hostiles. But hostiles are pretty challenging, and sometimes people don't sort of recognize the challenge. Overall, 70% of hostile offers fail.
Right.
So even if you take your best shot, which is a sort of high premium cash deal, in many cases, companies are able to fend it off.
Yeah, I think you can group potential acquirers into two camps, right? Strategic buyers who are out to add capacity to their own fleet, add differentiation to their company, and more non-strategic buyers who are out there, see the valuation gap, and think that by buying a fleet, they might be able to break it apart and get more out of the pieces than the whole. On the strategic side, there are a lot of concentrated shareholdings there, tough to attack hostilely, and we as owners, ship owners, it's a pretty small industry, and we don't like hostile stuff very much. On the non-strategic side, there is this gap there. People have paid down their loans on their balance sheets, creates some opportunities for bootstrapping. I think maybe that can happen, but the risk there is that in this very cyclical market, they buy the assets and the market falls away from them by the time they complete the deal and sell off the pieces. So there's a risk there that people are still licking their wounds from the last time that happened.
I see the time is ticking here. Maybe I want to give people an opportunity to ask any questions if they have any. If not, I'll continue, but. All right, well, I'll continue then. So one thing, I do a lot of M&A outside of the shipping space. And one thing I've always kind of been curious about is why, obviously, private equity came in heavy to shipping for a while, and they kind of fell away, and that's ebbed. But why haven't we seen more sort of non-traditional players come into this space?
Well, I think in part, there's only a minute or two left, so I'll go quickly.
Yeah.
Look, the track record has been mixed at best, right?
Yeah.
And two, private equity typically takes the point of view, in many cases rightfully so, that they can impact the arc of the business and the operations of the business.
Yeah.
It's difficult in most of these sectors to do that. It's really the cycle more than a lot of micro things that you might do at the company. So it's not an ideal setup. It's also, I don't think most PE firms want to be doing highly cyclical, volatile trades. There's a few out there that have done. I mean, Entrust has done a really nice job in that regard. So it's not like they're zero, but I would say I wouldn't expect to see a bunch of private equity firms start to get involved. We have seen infrastructure firms
Right.
get involved with respect to the more consistent parts of the business. We've seen that with, Gaslog, Hogan, and some others.
Yeah, well, one of the situations we saw in offshore wind was the supply-demand balance of the industry looked great. But the challenge with private equity was there's only a small number of people who can operate these assets with the proper infrastructure and team to do it. And the other part was that the contracts were too short-term, 6, 8, 12 months, and they were looking at longer-term contracts, and what happened, the company would have to underwrite that risk, and that was not something that we were willing to take. And I think you can put that across, multiple sectors as well. If you look at tankers, 3 to 5 year charters more recently have been coming online, but over the last 5, 10 years, you didn't have a lot of those unless maybe they were tied to a new build or a new technology. So I think that is in addition to Mark's point on just where we are in the cycle, a big constraint.
Yeah, when I think of non-traditional, I think of the other than Greek or Norwegian families who invest in shipping, and maybe other than public companies. There always have been, and I think there always will be, non-traditional ship owners and operators out there. Glencore, ADM, Cargill. On the oil side, you've got tons of companies that want to get in to expand their supply line, supply chain, and get more control of it. So when I think of non-traditional companies, I think that way.
Well, it looks like we're out of time. I want to thank the panel for participating. You guys were great. And again, unless anyone has any other questions, I think we'll break for coffee.
Thank you.
Thank you.
Thanks.
Mark, thanks very much.
That was good.